Mortgage lending continues to grow to dizzy heights. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. The last working day of each month is when we get lending and credit aggregates from both APRA and the RBA. So today we're going to look at the latest numbers to the end of March 2018. And let's be clear, all this talk about mortgage tightening has only had a marginal impact on overall mortgage lending growth. We're going to start with the APRA statistics, which of course do not include the non-bank sector. So we're looking at authorised depository institutions, or ADIs, aka banks. Anyhow, according to the APRA statistics, the ADI mortgage book rose 0.46% over the month to 1.62 trillion, up 7.9 billion in the month. Within that, owner-occupied loans were worth 1.06 trillion, up 0.63% compared with last month, and investment loans rose 0.15% to $554.8 billion. Investment loans were 34.3% of all loans. The annual growth rate on the book would equate to 5.6%, which is still well above inflation and wage growth at around 2%, which means that in absolute terms, household debt is still rising. The monthly trends show the relative movements nicely, with owner-occupied loans still above investment loans, and just a slight fall in growth rates, but nothing to write home about. Investor lending was up a little. So we continue to see significant variations across lenders as to how they have managed their portfolio growth, with Westpac continuing to stand out. Now, of course, that's the bank which UBS suggested last week had issues with their portfolio and was potentially a risk, while CBA and ANZ appear to be reducing their investor loan book. Macquarie is also growing their book, as is Bendigo and Adelaide Bank. Overall loan shares are pretty static, with CBA the largest owner-occupied lender and Westpac the biggest investor loan provider. And recently we found out that 50% of their loans were interest only. Whilst APRA has removed the 10% speed limit, we're going to continue to report the annual movements by lender. A number of the smaller players are still growing quite fast. So let's now turn to the RBA credit aggregates to March 2018. Looking at the month-on-month movements, total owner-occupied loans rose 0.6% or 6.89 billion to 1.16 trillion, and investor mortgage lending rose 0.17% or 1.03 billion to 590.2 billion. So overall mortgage lending rose 0.46% in the month, up 7.92 billion, all seasonally adjusted, up to 1.75 trillion. It's a record. Personal credit fell 0.12% to 152 billion, and business credit rose 0.88% or 7.99 billion to $913 billion. The trends show that the share of investment loans fell a little in the total portfolio to 33.8%, while business lending was 32.5% of all lending, just up a little. The 12-month average growth rate show that owner-occupied loans rose 8.1%, while investment loans grew 2.5%, and business lending rose 4.2%, and personal credit fell again. Overall growth rates of credit for housing slid just a little to 6.1%, but this is still 3 times the rate of inflation and wage growth. Household debt, therefore, is still rising. The noisy monthly data highlights the volatility in the business lending trends. They also showed that switching between investor and owner-occupied loans continues to run at similar levels after the hiatus in 2015. Now, we can also make comparisons between the total loan pool and those loans written by the banks, or ADIs, by combining the APRA bank data and the RBA data. Now, there are a few catches, and the ABS suggests that not all of the non-banks are captured, but set that aside, we've plotted the relative value of the mortgage pools at the total level and at the ADI level. It's not seasonally adjusted, by the way. The trend shows that around 7% of lending is non-bank, up from 5.7% in 2017. And in value terms, this equates to $124 billion, up from $90 billion in 2016. Another way to show the data is to look at the rolling 12-month growth trend. This shows that non-bank lending has been growing at up to 30% and significantly higher than the market at 5.94%. Now, this is highly relevant given Bluestone's recent announcement and Pepper's recent $1 billion securitization issue. So, this is all playing out as expected as the majors throttle back on new mortgage lending under tighter controls. The non-bank sector continues to pick up the slack. And this is a concern as the regulatory environment for those lenders is weaker, with both ASIC and APRA now involved. ASIC from a responsible lending standpoint and APRA from new supervision on the non-bank sector, despite their failure in the core banking area. So we expect to see significant non-bank lending growth ahead, which will stoke the current massively high household debts even higher. Finally, it was interesting to read Moody's assessment of APRA's changed stance relative to the 10% speed limit for investor loans. In their piece, Australia's tighter bank regulation will contain risk from removal of investor lending restrictions, therefore a credit positive. Overall, they see the underwriting standards rising, reducing risk, though they recognise some potential to lift investment loan volumes, which is inherently more risky. They discussed APRA's intention to remove the current 10% limit on investor loan growth, replacing it with additional requirements for bank boards to comply with APRA's guidelines for lending policies and practices. And although removal of the cap on investor loan growth will likely spur growth in investor lending, they say, and they view that as more risky than lending to owner-occupiers, APRA's increased oversight will ensure that bank underwriting continues to strengthen, which will contain the risk, which is credit positive. For a bank to gain an exemption from the limit on investor loan growth, the bank's board must confirm that it has operated below the 10% limit for at least the past 6 months. And of course, investor loan growth for the banking system has been running up well below 10%. The board also will have to provide a written confirmation that lending policies meet APRA's guidance on serviceability assessments as set out in Prudential Practice Guide APG 223, Residential Mortgage Lending. In particular, banks' underwriting will need to include interest rate buffers comfortably above the 2% point and interest rate floors comfortably above 7%, which must apply to a borrower's new and existing debt. Haircuts to be applied on uncertain and variable income, such as, for example, at least a 20% haircut on non-salary and rental income. And for interest-only loans, an assessment of serviceability for the remaining principal and interest repayments after the interest-only term. Furthermore, the board must also confirm that lending practices meet APRA's guidance on the assessment of borrower financial information and management of overrides, as set out in APG 223. In particular, the bank will need to commit to the following: improved collection of a borrower's expenses to reduce refinance on benchmark estimates, such as the household expenditure measure, strengthen controls to verify a borrower's existing debt, and prepare to participate in the new comprehensive credit reporting requirements that takes effect from 1 July 2018. And under the new regime, information shared by banks on a customer's credit history will be expanded beyond just reporting negative behaviour to provide a more balanced assessment. Setting risk tolerances on the extent of overrides to lending policies, and develop limits on the proportion of new lending at high debt-to-income levels, where debt, for example, is greater than 6 times a borrower's income, and policy limits on maximum debt-to-income levels for individual borrowers. So Moody considers APRA's increased focus on lending policies and practices will be a strong mitigant against the risk of a significant rise in investor lending. And indeed, they say, APRA has cautioned that a return to more rapid rates of investor loan growth could warrant the application of counter-cyclical capital buffer or some other industry-wide measure. Furthermore, APRA's announcement reflects its recognition that since the introduction of the limit in December 2014, banks' loan underwriting standards and lending practices have improved, as reflected by the decline in investor interest-only and high loan-to-value lending. APRA also cited strengthening bank capitalisation, which has been supported by higher regulatory capital requirements. Banks will have until the 31st of May 2018 to provide all necessary confirmations for the removal of the investor loan growth benchmarks on the 1st of July 2018. Now, I think it will be interesting to see whether investor lending takes off again, bearing in mind that even now the total loan mortgage growth is still significantly higher than income growth, and this is not sustainable, and it will lift mortgage stress even higher. Our new data, by the way, is out in a few days. So we still think the over-reliance on mortgage debt to grow the economy is intact, and it will create significant problems ahead. We need to see credit start to shrink because incomes won't catch up anytime soon. If you like what you've seen here today, please like the post and add a comment or a question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new research, do subscribe now. And I want to thank those who have already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.